Ajay Srivastava is Reddy and Ajay. Did I just notice something different? New look?
Oh yes. New look, because that's the way, the new trading scenario. New financial year, a new way to trade the market. Nothing long term, you can cut it off at the moment's notice.
Okay, so what are you doing in the short term? Since you're insisting that we should forget long term for a minute.
Of course we should forget long term, because you've seen the market. I think it's no genius to tell us that there is no way to plan a very, very long term, even a 1 year kind of strategy in this market. You are seeing reversals, you are seeing peaks, and it's running so fast that it's kind of unbelievable that you can actually pinpoint a long term winner at all. Maybe barring 4 or 5 stocks in the market, there's no way one can say for certainty that at the end of the next 1 year, this stock would give us 25% return.
The two factors which are at play at the current juncture are, one side you've got the macro adjustment, which is positive. Other side you've got the earning adjustment, which is negative. So which factor do you think in the near term will have a bigger or a greater influence on Indian equities? Earning adjustment or macro adjustment?
I think it will be the earning adjustment, because what's happening is that the demand scenario is collapsing in a much worse fashion than all of us imagined. If we thought March was bad, what we are seeing April is a disaster staring in the face of most companies who are in the domestic market. So I think you will see the results of April sales as they come out. I think they'll be pretty grim to look at. Nothing tells us that May and June typically are bad months in any case. So, you're looking at the first quarter of the year with a pretty bad earning impact coming out because of the demand scenario. And it's not, demand is not something government can kickstart overnight. Other things you can do, but demand is something which will take time for it to come up together. So if you're expecting a steep V-shaped recovery and demand, I don't think that's happening. So I believe that yes, macroeconomic, there are lots of positives, but the biggest positive of macroeconomic is the biggest negative for demand is the government cutting down fiscal deficit. Means government spending goes down, means that the money supply in the market goes down, and therefore velocity of money, whether it be 1, 2 or 3, the demand will be collapsing much more than the fiscal deficit cut down. So it's a scenario which is scary, and I think you already seen the numbers coming from car, auto, consumer, every company. Nobody is reporting growth. People are all reporting negative numbers.
3 large index names have come out with their earnings already. Infi, Reliance and TCS. What's the prognosis now? How do you think the rest of the earnings will pan out?
I think the only sector which will pan out is the bandit sector called the banking sector, because they will produce stupendous results thanks to the RBI's protection given to them in terms of competition. So I think that's one sector which is well protected, and one should look forward to very good quality results. I don't think any other sector which is going to give decent results. Maybe barring the oil sector could spring a surprise, and that's one of the sectors when I said we could not pinpoint more than 5 shares or 10 shares which you would like for a year. Oil sector is one of them. They would like to be there if you're not already there, and that's one sector which could surprise on the upside. Apart from banking should give a normal results, don't think any other sector would surprise in the upside.
When you say banking, is it a blanket bullish call, or again there are pockets in terms of PSUs or private banking lot?
See, we all know that the 3 or 4 private banks will deliver 28 to 30% result. So you're almost sure that ICICI Bank and HDFC Bank will deliver. Yes Bank has already delivered the result. IndusInd has delivered. So both two will deliver the results. I don't think Nationalized Bank will deliver the results. And even if they deliver the results, I'm not sure how credible the results will be. My belief is they will deliver much above market expectation being the March quarter. But whether their credibility is okay on the result side, I'm not sure. But the results would, across the board, I think in banking, would be much above expectations, at least the nationalized bank sector.
If you map the risk-reward ratio at the current juncture, do you think the risk-reward ratio is slightly favorable for Infosys rather than TCS? No, not at all. I think, there are 2 issues with Infosys. One is, are you saying the company will improve in the next quarter? The answer is perhaps looks very difficult. You can't make the elephants dance. Only one guy could do it in IBM. This guy is not going to dance in a hurry. Number 2 is that the issue with Infosys, if you look at it, is quarter-to-quarter volatility. My view is that the next quarter result will be much better than what they're given. The stock price will go up, and next quarter again it will climb down. You look at the pattern of Infi results. That's what's been happening here. So I'm not sure is it deliberate or is it by accident that you're seeing quarter-to-quarter volatility in management summary as well as the performance. So if you're asking me by the next quarter will the share price be up, I'm almost 100% sure I could put my neck out to say next quarter results will be far superior to what they delivered this year, and market will see a leg up. So again, back to the point of Ashwani, I think the next quarter, yes, you will see the market going up for Infosys, the price going up. But whether long term is going to change very dramatically in the next 6 to 9 months, unlikely. But if you're playing for the next quarter, just buy in my view before the results come out, maybe week, 10 days, and then take the kick upside and then sell out again. This is a volatile stock, this is a quarter to quarter stock, and that's the way you should deal with it at this point.
Whereas the buy and hold strategy has not worked for Infosys, it has clearly worked for HCL and TCS. For those who bought HCL and TCS exactly 2 years ago, they're well in the money.
You know, I'm not saying that buy and hold is not working. It's working for many stocks. You look at the United Spirits, United Breweries, which are the thing. You look at HDFC Bank, ICICI Bank, they're all given returns. The question is that, you know, when you're putting equity money, we're talking of 20-25% return per annum. That's your expectation given the risk you've taken in this kind of market. That's the return we are not seeing coming out by the hold and then strategy. Yes, odd stock will come out, but when you build up a portfolio of maybe 8 to 10 stocks, we're not able to get that 25% return in the market. But when we look at the trading part of the portfolio, we are able to generate far superior returns with much less commitment of capital on a consistent basis, and we also sleep much better.
What are your thoughts on runbacks, Ajay Srivastava?
See, you know, it's a good stock to be in, but, you know, Japanese parents have never been good parents of companies on the listed side. That's an honest fact, because I don't think they have grip with the situation. Every good performance of a quarter is balanced by the next quarter. If you look at the last 6 results, quarterly results of Ranbaxy, every alternate or every third quarter, they have one very bad news filtering in. Perhaps the market is feeling that the end of the bad news has happened, so now it will start to move with the rest of the industry. That's one alternative. The question is, should you buy the stock and keep it in our portfolio? We have it in our portfolio. The answer is yes, because it's got a very good domestic products. It's got very good consumer products. You all heard about Revital and Move, etc. So there is a good portfolio of consumer products, pharma products. Indian market is doing well. I think they've fixed the US problem by and large. Negative surprises on currency side should be over, at least in a major way. So in a manner speaking, it's kind of a purging of all the sins that's come through. And this stock, if I'm not wrong, we are looking at should touch about 600 at the end of 12 months.
Ajay, you were earlier reiterating as to how you see earnings visibility in the oil and gas space. When you say oil and gas, are you meaning the OMCs or is it the ONGC and Cairns of the world?
I think it's both. Because, you know, and at the nationalized sector, both of them are trading at a valuation which is significant discount to anything global. Our oil marketing companies are about 0.9 times book value, which is less than 1 times. Our oil producing companies are about 2.5 times book value. That's the way it is, which is significant discount to, and if what the finance minister said is correct, then 1 year down the line, we should be looking at doubling of this valuation on the book value basis. You know, if they do a decent work, we could look at a 40-50% appreciation in share price at the maybe 15 to 18 months from today. That's what I'm saying. On the book value basis, I'm not just saying earning basis, because earnings, I presume, as the subsidy burden drops out, they will start to get into positive territory. HPCL was negative, so you can't do a PE kind of ratio. But just look at the book value, look at the international comparables, and then you say you're on a safe bet. Oil producing is a little doubtful because one doesn't know what's going to be the impact of the shale gas coming out of the US in the next 2 years. Is the price going to crack dramatically, in which case their profitability will get impacted? So safer to be on the oil marketing company side, who are low on the valuations, have a straight pass-through margin, than on the oil producing, barring Oil India, which is a peculiar animal of low valuations and high profitability. So Oil India at a P of 10 or 12 is a good candidate of a high profit, low profitability, but oil marketing are good candidates for low book values compared to international peers.
If I look at the financials for oil marketing stocks, they always get compensated by Government of India via oil bonds. So at a net level, the increment benefit will not kick in. Yes, because of oil sector reforms, the book value will go up and the total debt burden will reduce. But the big jackpot perhaps will only come for ONGC, because for them the net subsidy burden will come down.
No, it's true, but you know, I don't think it's correct, Nukun, to say that they get 100% of the subsidy in terms of the bond. I think there is a formula which leaves a lot of subsidy burden onto these companies, including a sharing with the oil producing companies. So even at today, I don't think they are getting 100%. I don't have the precise, my analyst tells me that they don't get about 70-75% of the subsidy burden comes. The balance they have to make good from their own borrowings or negative. That's one. Number two is, you're right. You know, the oil producing companies' subsidy burden may almost evaporate in the year's time to come. That's why I said, they look good. The only thing which is variable is the price of oil itself, and the impact of the shale oil which is going to come out of the US, and that significant investment has gone in there in the last 4 or 5 years, and the next 2 years the results will start to come out. So we are not very clear as to what happens to the oil prices per se, and that's the doubt in our mind, that in the next 2 years or so, or next year or so, will the oil prices remain at this price to give the huge margins to these companies, or will they come down quite substantially, and therefore the margin of these companies would also kind of come down a little bit. That's why the doubt is there. Otherwise your logic is absolutely correct.
Ajay, what about the next leg of the commodity basket? We've spoken about oil and gas, but metals, is the worst over for names like JSW or Tata Steel, or not quite?
I think so. We have started to build up, as I said, we've increased allocation, we're building up positions, both in steel and the non-ferrous sector, like things like Hindalco in India, Sterlite, little bit, not too much, but little bit on, we are saying that, listen, is it what we are seeing the bottom? We can't predict it. Maybe 5-10% will still go down. But definitely, I think, it can't go much worse, and we are already in a recession. Literally, IIP is zero, consumer is down to 1%, and so on and so forth. So I think we are really scraping the barrel. And if the government's fiscal disc happens by the end of the year, they should start to come back in the market to spend money. So it's a 12-month waiting game which is happening. I think it may be too early to commit big capital to these sectors, but nibbling, yes, it is, I think, recommended.
The three names you gave me last time when we interacted with you were A, SpiceJet, B, United Breweries, third, Tata Tea. What are your three new names now?
No, I think it was Tata Global, if I'm not wrong, not Tata Tea.
Well, it's become Tata Global now.
Okay. So yes, now I think in the last 1 month or so, we added, I think we named the two Malia twins, we've added up quite substantially in the portfolio at this point of time. So that's been the big addition in the last 1 month.
Ajay, what's happening with United Spirits, and how much more headroom to go for the stock?
Lots to go for the longer run, for the simple reason that I think the equation is now very clear that they will have to come to the market to buy the shares. That is one. The banks are not selling the shares at this point of time. Therefore, if Diageo has to take 51%, they've got to bring in money at a serious rate in the company. That's one. Fundamentally, the stock is at 5 times book value. If you compare that to a Dabur at 20-25 times, the Nestle at 40 times, you're talking of a serious headway coming in terms of valuations. So, I think market has picked up at 1800, 1880 is what the range was for a long time, that this story is going to go much higher and longer, and that's why the built up in positions. And I think it's going to, you've just got to have faith in this stock, that to believe that even if it tries to double the book value over a period of 2 years, you're looking at serious money in the game. So I think the clearest indication is these two twins are out for a good ride, irrespective of what happens broadly to the market. If there's a severe cut, you add on to the position. This is one stock you don't want to sell out.
But Ajay, is it fair to compare United Spirits and Dabur, because the dynamics are different, categories are different? Dabur is a zero debt company, HUL is a zero debt company, Nestle is a zero debt company, United Spirits has a lot of debt.
Yes, but look at this fact, that it's a monopoly, one. Number two, it's very difficult to get a license to do anything close to liquor in this country, and for a long time it's going to be very difficult. Number three is that after the exit of Malia from the control, I think you'll find financial management will improve substantially in the company. Number four, we have such a strong international sponsor which will get access to capital, and debt will become much easier and much cheaper. So the set of circumstances are building up to the scenario that the lot of excesses in the system which was holding the valuation back are all kind of going to go away or already disappearing, and that's why you've seen the prices moved up from 1400 to 1800. Now it's the next leg is 18 to 2400 leg, which is what we are on currently. So there are four sets of good things happening there. And the number five, the biggest important thing is that the competition. There is no competition. Between both in the brewery side, on the beer side with Heineken sitting there, and on this side with Diageo. Where is the competition? The next guy is about 10% of the size of this player compared to consumer companies, which is a dog-eat-dog world.
Oh yes, indeed. You've certainly done your homework on that. I also want to flag off Radico Khaitan, because Radico Khaitan has also moved up quite substantially and quite smartly in last 2 or 3 trading sessions, and this is one stock where FI ownership in last 1 year has gone up by about 10%. Radico Khaitan is trading at a PE multiple which is nearly 50% discount to United Spirits, and United Spirits is a stock which is trading at a 50% discount to the FMCG market. So with that logic, Ajay, Radico Khaitan should also be a buy?
But it's a small stock. That's the only point I have. It's a very promoter-driven. I think promoter holding is in majority. The only play there perhaps is not the company play, but will they sell it eventually? I think that's the play there. On a standalone basis, if you want to allocate capital, you would rather allocate capital here. Speculative basis that this could be up for grabs of the company, which I don't think it is, because that's rumor has been in the market for a long time. I'm not sure it's a thing. It may give you a bigger bang for the buck, but the risk is equally higher. So be safe, play safe, and why risk your money?
Ajay, we always end up focusing on the long positions you currently own. What about the short side of the market? What are your current short positions?
I have no short position in the market at all at this point of time. It's all finished and closed.
And why is that?
I think, there are a set of positives building up in the market, and you don't want to bet against the mood of the market. You may not like the fundamentals, but the mood of the market is telling us that it is not willing to go down much further or substantially lower. So risk reward is telling us you better be on the long side at this point of time. You may cut it in a week's time, but as we sit today, its mood is not to go short, because short can hurt you very badly, and you've seen the volatility. So stay long in select stocks, but short is not a good idea today.